Hey everyone, and welcome to my channel. If you've ever wondered what the term owner's equity means, well, you're in the right place. Today we're going to go over some of the foundational concepts and then also some of the jargon that goes along with it so that you can have a better understanding of what's going on when you hear the term owner's equity. Let's start with the basics. Owner's equity is a term you're going to find on the bottom right-hand portion of the balance sheet, right below liabilities. It essentially represents your stake in the company, so what you own of the company. In other words, it's the assets minus the liabilities is your portion that you funded of the company. So where does owner's equity come from? Well, when you start a business, you have two main ways to fund it. First of all, you can go out and get a loan that's going to show up as a liability on the balance sheet, or you can invest your own money. In other words, the owner's equity section of the balance sheet. You can bring in cash into the business, equipment into the business. You can even bring in your car into the business. All of that funding is going to show up in the owner's equity portion. It's basically what you've put into the business over time. A very specific example we could use is, say I'm starting a business and I have $10,000. I want to fund my business checking account with that initial deposit of $10,000 from my own personal bank account. What that's going to mean in the general ledger or the accounting books is you're going to see a debit balance to cash, which is going to increase cash, and you're going to see a credit balance to contributions because you just contributed $10,000 of your own money. So that's going to be $10,000 into the owner's equity section of the balance sheet. Now let's talk about retained earnings. Retained earnings represents the net income that you have gotten over the year that you've reinvested into the company, aka you haven't taken it out of the company. Say I made $10,000 in profits, I left it in the bank account, it's the end of the year. What that does is it means that when we're truing up the income statement, we're gonna say revenue over expenses, you made $10,000. Now we're gonna clear the income statement for the year. Where does that $10,000 go? Well, it gets credited to the retained earnings section of the balance sheet. Owner's equity is something that ebbs and flows over time. So you're going to see it show up as an increase with contributions. Say if you want to put personal money into the business, you're also going to see it decrease with what's called draws. It's a very common account in QBO. It's going to be anytime that you take cash from your business account and put it into your personal account. Another way that you're going to see owner's equity increase and decrease is in the retained earnings section. So if, say, for the end of the year, you net an increase to your total net income, your profit and loss statement is positive, you've made cash, you're going to see this show up as an increase to retained earnings at the end of the year. On the other hand, if you don't make a profit for the year, this is actually going to decrease your retained earnings account. So you're going to see your owner's equity ebb and flow between retained earnings, contributions, and all of the miscellaneous accounts that can reflect owner's equity that have a bunch of other terms, but essentially boil down to those two main concepts. Now here's where some small business owners get into trouble. Personal purchases with business funds. For example, if you stop at the grocery store and use your business credit card, your bookkeeper will need to mark that transaction as a decrease to cash and an increase to owner's draw, or the withdrawals from within owner's equity, because you're taking business cash and turning it into personal funds. Essentially, you're using money from the business. So that is considered an owner's draw. Typically, we only want to see the owner's draw show up as a transfer from the business checking account to your personal checking account. Ideally, it's the same bank accounts over and over, so your bookkeeper knows how to classify those. But you really shouldn't be making personal purchases with your business credit card because it can make everything messy. There's multiple ways that you can mess with your owner's equity account. The best thing you can do for yourself and your bookkeeper, though, is to make sure when you want to take money out of the business account that you make a direct transfer from the business account to your personal account. And that's owner's equity in a nutshell. To recap, it represents what you personally own in the business, what you've contributed over the years. It grows when you contribute, shrinks when you take money out. And keeping personal and business transactions separate is going to save you a lot of headaches and your bookkeeper as well. If you found this video helpful, please make sure to give it a thumbs up, subscribe. If you have any questions, feel free to drop them in the comments box below and I'll get to them when I can. And thanks for watching. I'll see you guys next time.